Well, g'day there traders and friends, market participants and enthusiasts right around the world. Thanks a lot for joining me in this weekend market update. Collectively, across the board, the three US financial markets did close up. It was another relatively healthy and positive week. However, we started to see a little bit of a slowdown. This took place on Tuesday, where we saw across the board the markets themselves print in a series of bearish dark cloud cover, individual candlesticks, if not bearish piercing patterns. This leads us to believe that the markets themselves are getting very, very close to the end of this terminal or this parabolic rise to the upside. It has been a tremendously profitable time towards the end of 2017, where in the month of November, collectively across the board, the markets broke out. We are seeing again the continuation of this move to the upside, but it looks as though we're starting to print very close to our target, especially my own personal target on the Dow Jones Industrial Average, 26,300. Please write this down. I'll write it down on my screen. 26, I should say, not 23, 26.3. Pardon me for my horrible drawing tool, but that does say 26.3. That is my own personal target. And this is, of course, a decelerating fan line that really starts and begins at the beginning of the bull market in the early months of 2009. Now, what I do want to make clear at this particular point is that we need to allow a couple hundred points you should say, swing in the actual target, and that is to do with the variance between that of the projection of that actual decelerating fan line. And what I mean by that is when you go through such a broad space of time, or at least countering in 9 years really since 2009 to where we currently are at the beginning of 2018, you have to allow a little bit of variance for those trend lines, the projections of those trend lines, because what has happened is that essentially this was a support level up until 2011. We broke down below this level. We've back tested it once already. We've held as resistance, and since the projection has continued into the future, here we are in 2018 and we're running up very close into it. My projection, just to reiterate, 26,300, give or take a couple of 100 points or so on the Dow Jones Industrial Average. This is the mantelpiece. This is what I'm looking at, or at least my perspective on the market. The S&P and the NASDAQ, although they can, of course, diverge short-term directionally, they will ultimately come back together. So if you see the Dow turn down and the NASDAQ and the S&P 500 continue bullish around this 26.3 area, if and when we hit that, expect that the margin of error, or at least the actual divergence between the two markets or the three counterpart markets, will actually come back together. And I believe they're going to follow the Dow Jones Industrial Average. It's very important that you understand this, because at the moment, a lot of people are jumping on the bandwagon of this market breakout, the continuation of this bullish trend. However, again, I'm just stressing the importance that it appears we are towards the end of this most recent wave rotation to the upside. Very important for you to understand this. The trades were meant to be placed. 24,909, 24,500, 23,600. And 39 points have been some past breakout entries that we are in on the diamonds. And now is the time to be thinking about, well, where do my stops need to be placed? We've just brought ours up to 25,900. And our target again is where I've already stated it to be a number of times already. So either way, whether or not we hit our target or we get stopped out, it is going to be a very profitable outcome that a lot of people are going to be happy about. I congratulate you for that. But again, I would be very reluctant in jumping into the end of this market advance. Statistically, the S&P 500 hasn't been as overbought as what it is currently printing since the turn of the 20th century. So we're hitting extremes in terms of market sentiment, market psychology, and the actual overbought nature of these markets across the board. So that is something for you to think about. Again, the S&P 500 is extremely overbought on the short-term time frame. You need to be well aware of that, and it is just lining up very, very nicely with the Dow Jones running back up to retest that the decelerating fan line that was broken for the first time in 2011. So the rest is relatively straightforward. S&P 500 and the NASDAQ. Not trading to targets on these on the SPYs and the Qs. The entry out is going to be whether or not we hit our stop on the industrial average or whether we hit our target on the industrial average. So the other two markets, S&P 500 and the NASDAQ, are going to be secondary to that of, or at least the primary importance is that of the industrial average. And the other two markets become secondary. And you can use contingent orders to leg out of those positions as per what the Dow Jones Industrial Average does. Now, what is interesting is that as we move up into this target on the Dow Jones Industrial Average, as the markets are as overbought as what they currently are, the individual stocks themselves are moving into their earnings. Some have already transitioned through earnings. We follow 12 stocks in that pro analysis class. I'd say maybe 2 or 3 have already moved through earnings, but the majority of our list, they are going to report over the next 1, if not 2 weeks. So it is going to be a little bit of a quieter period. We're going to have to follow along with what these individual stocks do as they move into earnings, and obviously what the response is by active market participants. But it is working quite nicely, and it is relatively a really nice overlaps or a synchronization between the earnings of the individual companies and just how the broader indices are priced at this current time. Until we start jumping into a bunch of new trades. So you can see for yourself, Apple is reporting the first trading session of February. The same is true for Amazon as well. Boeing Airlines is the last trading session of January. So again, the first 2, Apple and Amazon, the first trading session of February. Boeing Airlines, the last trading session of January. You've got Baidu, which is still yet to report, but we are in these positions since 238, if not 242. We're trading at 256 or just shy of that figure. So that's a pretty decent trade setup. Caterpillar, we've capitalized on very, very nicely. 140, I mean, as far back as about 115. We hit our target at 158. It's run since, but again, we've got that earnings announcement this coming Thursday. So, I mean, there's not enough time to jump into Caterpillar. COP is the first trading session of February. We have CVX again. It looks like the third trading session of February. Google, the first. We've got Goldman Sachs, which is a pretty decent bidirectional trade setup. I went through the analysis as to why we're doing such a thing just recently. Actually, that class is now up online at the website. But a pretty bidirectional trade setup on Goldman Sachs. It doesn't really bother us which direction it chooses to go. The good thing is that we have transitioned through earnings, so there's no longer a need to actually liquidate any positions prior to that. We've already done so, and now we're on the other side or through the tunnel, so to speak, and we've got another sort of gasp of fresh air, so to speak, of trading activity ahead of us, which is exciting. We've got IBM, which has just printed in potentially an island reversal, a major sort of bearish reversal signal here. We're going to have to monitor this. There's not enough information at the moment. It is relatively bearish short term on this individual stock, but the market itself is still collectively bullish. I mean, this is counter trend, but this is a very ominous sign for IBM on elevated volume as well on Friday, which is something we spoke about in great detail. We've got Netflix is reporting first thing Monday. And then again, Tesla. Tesla is something that I'm skeptical on at the current time. I don't think this is going to be a sustainable bounce up to 380. We might get up to 380, but the odds are that we are going to reverse sometime between now and then. And if we do break below 314.97, hold on, because this is going to be a monumental fall, probably short term and also on the intermediate time frame for Tesla, because we've got a lot of reversal signals, whether it be divergence or chart patterns going on Tesla at the moment, and it is starting to very much so worry me and a lot of other people as well when it comes to Tesla moving forward, or at least into the first half potentially of 2018. If you'd like to learn more, email me success@pivotpoint-trading.com. And I would be happy to answer any questions that you may have. If not, have a look at that pro analysis class if you want to learn how to break down the US financial indices and also individual top 12 lists through the eyes of an active market technician. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Enjoy your weekend. Farewell.